Hello, what's up, my wonderful traders? Trust you're doing well. Welcome to this segment of the videos. So, have you ever wondered why, to some extent, you are still blowing an account and having some massive loss, even after learning, most of the trading strategy, even on YouTube and whatever platform? You know, the problem is not about your strategy. It is just what you do not do before using it, right? Yeah. So if you are trading without this, just note that you are basically gambling. So the essence of this video is for us to examine this concept, which is backtesting, and to see how it is important to us as traders, right? So let's get to work. So first of all, what is backtesting? Backtesting is a fundamental price it's a fundamental practice in trading that involves applying a trading strategy to historical market data, right, to assess its potential effectiveness. Let me even bold this. So this process allows traders to evaluate how a strategy would have performed in the past, right, providing insight that can inform future decision. All right, so as a trader, you have learned so much, you have learned a particular strategy, because the first process is always to learn, right? So you learn a particular strategy. So let's say you learn a strategy on let's say on price action, that is support and resistance. So how then do you go to implement this strategy into your trading plan, and how to use it to be effective? What you need to do is back testing. Back testing is the testing of historical data, like, right? Because as a technical analyst, there's one thing we know as common, that what price did in the past, it is likely going to repeat itself again in the future. And that is why we have chart patterns, we have candlestick patterns. So why are they patterns? They are patterns because they are repeatable, right? Yes, because they are repeatable, that is why they are called patterns. And so as traders, as technical analysts, we need to evaluate this, and we need to test this data with this particular strategy, right, to give us to validate our edge, right, and to position us to know the outcome of this particular strategy at each time. All right, so why do we backtest, or why does backtesting matter? So number one, we have validate strategy effectiveness. Like, this is a whole lot. So now, assuming you have learned a particular strategy, and now you are okay, you learned the strategy on euro USD, and maybe, okay, you learned the particular strategy, or the person that taught you this strategy used it on euro USD, and you were thinking of applying it in maybe USD JPY, or let's say gold. Yes, gold for instance. So how do you test to know the validity of that strategy, if it is effective? So number one, backtesting helps determine whether a trading strategy is likely to be profitable. By analyzing historical performance, traders can assess the strategy's potential success in various market conditions. Okay, so this is it now. So now you learned a particular strategy from a tutor. Okay, let's say price action, support and resistance, and you learned it. The example that was used there was euro USD, and now you are thinking of diversifying, maybe US tech or gold, or or USD JPY. So how then do you just go to live market and start trading? No. What do you need to do? You need to back test using what? Using historical data, using what has happened in the past. You relate with that, so to know the effectiveness of that strategy, right? And also, in market conditions, like you can see here, analyzing historical performance, traders can assess the strategy's potential success in various market conditions, because there are various market conditions. We have a bullish trending market, we have a bearish trending market, we have a consolidating market, or a ranging market, as the case may be. So in each of these cases, the strategy will not work as it is supposed to work like when you land it, right? So it is good for you to test it and to see. So number one, to validate strategy effectiveness. So number two is to enhance confidence. So seeing a strategy perform well in backtest can boost a trader's confidence, making it easier to stick to the plan during live trading. Alright, so here's the point. Get this. Trading is all about you progressing in your knowledge and your understanding of how the market behave, and how you can manage yourself, and how you can profit from all of this, right? Yes. So first, where as a beginner in trading, you are all about the technical analysis, right? You are all about trying to figure out a good working strategy, to figure out your edge, right? And then you be exposed to so many of them, but you are trying to validate your strategy, so that you will not just be trading impulsively or without any clear rules or systems, because the the freedom of creative expression in the market is 120%. So you have to set rules for yourself to guide you in navigating through. So now, you and I'm sure that you heard about people are saying, oh, in forex they lose money, in forex they lose money. Yes, you can lose your whole savings, you can lose your whole account in forex, but then you need to ask yourself that, is it everybody that is losing this money? Like, is it everybody that is blowing up their account? So if just in case you find out that it's not everybody that is blowing their account, that means there is something you need to do to make you have the result of those other people, right? So number one of them is confidence. You see, in trading, you are supposed to be confident, and this is it. You are not being confident like yeah, like cockiness, like you are proud, or you are having ego. No, being confident in your system, in your strategy, in your in your set of rules you have set in place for your trade execution, right? So you need to be confident, because if you are not confident, you will see your trade play out and you just keep missing opportunities, and you say, oh, I would have gotten into this, you would have gotten into this, and a whole lot of stuff like that. So backtesting helps you build confidence. So the next one is identifies weakness, right? So backtesting can reveal flaws in a strategy, such as overfitting or unrealistic assumption, allowing traders to refine their approach. Alright, so like we have different phases of the market. The market can go into a ranging phase. So if that your particular working edge does not work well in a ranging market, you're not even supposed to trade a ranging market. I'm just using that for example. Or if that your particular strategy is just for, okay, it's a kind of short-term strategy, because we have different types of traders. We have the swing traders, the day traders, and the scalpers, right? So as a scalper, you can trade in a consolidating market, but as a swing trader, you must avoid consolidating market, that is a ranging market. Because why? You are trying to catch swings of price movement, right? Because that is the only way you can make your money. So you identify, when you backtest, you know that, okay, this strategy is mostly good in this, okay, it's mostly good in ranging market. So you know that, okay, this strategy is good in ranging market. That is a strength in that strategy. And then maybe as a scalper, you are just entering exiting, and maybe you aim to benefit from price, from a ranging price, right? So that you can also evaluate that to see if there's a weakness in that strategy. And the truth is that you need to know the weakness and the strength of your strategy. Very important. All right, so the next one is what? To improve risk management by understanding how a strategy performs. under different market conditions. Traders can better manage risks and set appropriate stop loss and take profit levels. Alright, so let me emphasize on this. We have day traders. There are day traders that their routine, they must take trade in every day, right? And as a day trader, for them to also make money, they need some certain price swing in each day. So what happens in a case when a market is just consolidating or ranging, like the other day, okay, let me just say this week was just done with from 8, okay 14 of from 14 of April to 19 of to 19th of April. If you notice on the Euro USD, it was just consolidating within a particular range, and for most day traders, they were just posting stuff all around in Twitter, in Instagram, in Facebook, that the market is just doing all a whole lot of stuff. Why? Because their strategy is not working there. And so maybe as a day trader, come into a flat market range like that, a consolidating market, in your routine you don't miss your trade, but then you can decide to reduce your risks, right? Yes, you reduce your risk so that your account can survive that stage of consolidation, because it is very important. Because let's just say you're risking 1% and maybe in 5 days you have 5 losing trade, right? So it's not too healthy, right? Although your trading plan is supposed to have a loss threshold, that okay, if you attain this certain amount of loss, you stop trading for the week. But then if you can spot some of this kind of condition, you can also reduce your risks, right? And then, or you avoid the market, right? But just in case, we are just examining it in this form, so you can reduce your risks. Yeah. So the next one is what? Is support data driven decision. So backtesting provide empirical evidence on a strategy's performance, enabling traders to make decisions based on data rather than emotions or assumptions. So as a trader, you don't want to make up decisions on emotions or just assumptions, but rather you want to work with clear set of rules, clear entry and exit plan, right? So backtesting all helps you, gives you shape in your trading. All right, so let's look at the common pitfalls to avoid in backtesting. So number one is what? Overfitting. So backtesting is like a design. It's like you are testing. Okay, your design, you have worked on a particular design, and now you are testing the design. You are testing to see that okay, this design is good on, okay, like let me just say kind of outfit. Okay, this dress is good for a summer period. Okay, this dress is good for a winter period. You know how to, you test it like a car. In a producing factory, they will test the speed, they'll test the engine capacity. Can it survive stress? Can it survive, can it survive pressure? Can it survive heating, overheating? A whole lot of stuff. So you need to test your design to know that okay, to give you this credibility that yes, you have you have checklist all of this and it is good to go. So the same thing for our strategy. Our strategy is a design. Backtesting helps us test it to know the effectiveness of our strategy. So number one, these are the pitfalls to avoid. Overfitting. What is overfitting? Designing a strategy that performs exceptionally well on historical data but fails in live market due to being too tailored to past conditions. Alright, so this is it. This is one thing about strategy. In building a strategy, you need to learn how to keep it easy and simple. You don't need to complicate stuff a whole lot, right? You just need to keep it clear and simple. If you are waiting for a retest, you say okay, after a retest and engulfing and you're taking your trade. You don't need to say okay, you're using MACD, you're using moving average, you're using volume, you're using ICT this and a whole lot of stuff. And when this one is conflicting, this one is giving you confirmation, this one is in a confluence zone, this one is telling you that there's nothing. You just need to keep it simple. So in your when you are backtesting, you need to tailor your strategy in such a way that it's a system. You are not just looking at price and be saying, okay, this is the market, this is how you would have taken this trade. No, but then it's a system. You apply the system to the market at any time. So that system you can apply it on Monday, on Tuesday, on Wednesday, or Thursday, and on Friday, just in case you're a day trader. So you just need to make it simple, not just tell all the long to pass data. No, but you need to make it simple so that what? So that you can repeat the process, because one of the things that make trading easy is the ability to repeat the process, right? Yes, so you can apply today, you apply next week, apply next month, and so on. Yeah, so we need to avoid the pitfall of just narrowing it down to only to pass data, but then you need to work on a system that you can apply to future price, as the case may be when you're looking for trade setups in the future. All right, so the next one is ignoring market changes. So assuming that past market condition will repeat exactly, which may not account for evolving market dynamics. All right, so pay attention to this now. You just assume that past condition. One thing you should know in the market is that no day will be the same as the other day. Like no day. If you know about double top, you know about double bottom. No double top will look the same 100%. No double bottom will look the same 100%. No patterns like head and shoulder, they will never look the same 100%, right? Yes, so assuming that past market conditions will repeat exactly is a zero. Is you don't need to think about that. Rather, that's why I say you need to make it very simple and repeatable so that you can apply it in the future, right? Yeah, so that is the goal. So don't be narrowed down on just past data, because maybe in past data you can just see, you can see a kind of rejection at a particular key level, but then in the future you might not see price reject at the key level. But then if it's in your system, you know that okay, you allow price to come into that key level. Stuffs like that can validate your setup, rather than just narrow it down to that particular key level, or maybe the key level is something 500 and you're looking for 500. No, you just have to apply the system to the market, right? Just apply it exactly. Don't don't manipulate anything. Just apply it and then work with it, right? Very important. So the next one is what? Neglecting transaction cost. All right, so this one, let me just use an example scenario. So all of this I'm just saying it from experience. So an example scenario for people that like sniper entry. So let me say their strategy, they were building it upon sniper entries, and then they forget that the live account of the trading is account that has spread. Spread is a disadvantage to us traders. Why? Because the difference between the ask and the bid price is when the difference between the ask and the bid price is wide, that is the spread. So that means when you are buying, you have a different price you are buying, and you have a different price to sell from, right? So there's a huge difference. So now, depending on the spread of your account, so now if you just narrow your strategy down on backtesting, and in your in your data, the candlesticks will be seen, you will just see everything clearly. But then if you were to visualize that from your MT5 or your MT4 or from any of the execution platform, you tend to understand that okay, at this time, this sniper entry, maybe it wouldn't have worked. Why? Because it was just a pinpoint entry, and so it will not have worked. Why? Because of your spread. So you need to put all of this in consideration. And as well, again, you need to put this also in consideration. Maybe you are a swing trader, right? And then you want to swing an exotic pair, and then you are swinging an exotic pair with maybe a 20 pip stop loss, and then maybe market is closing within your entry point. You just need to know that when the market close the spread will be more than your stop loss, you might end up losing more. So these are some of the things you take into consideration. Like I'm saying this from experience. There was an account I was trading one certain time, and then I was just holding the trade. I was in profit, right? Was in profit, and I would have still been in profit. But what happened as the day closed, because of the broker, the spread was just expanded, and my normal SL amount was even neglected, and I had to lose more. Why? Because I neglected what slippage and market closure, and so that was a way of me learning the hard way of how to manage that. So you don't want to neglect commissions, slippage, and other trading costs that can lead to over-optimistic backtest results. Take note of this. First, overfitting. What is overfitting? You are just narrowing your strategy on only historical data. No, you don't want to do that. The second is ignoring market changes. That is assuming that past market conditions will repeat exactly. They will never repeat exactly. Rather, you can develop your system, that's your strategy, your edge, and you apply to every market condition, and as your strategy entails daily, weekly, monthly, as the case may be. And as well, you don't want to neglect the transaction cost. You want to put all of this in place, right? So maybe your strategy, you're getting a 1:3 arrow, and then maybe at the end of the month you got maybe a 15 risk to reward, right? So you need to know that in all those trades there will be commission, so you need to be realistic in your evaluation, right? All right, so now let's go over to an example of backtesting, how you can approach backtesting. Please stay with me. You love this part. This is the most interesting part of this video. All right, so first, now what do we need in backtesting? So let's say we are backtesting the Gaussian FS breakout plus supply and demand strategy. So first of all, you need your tools for backtesting, which we know the I love TradingView, right? I love TradingView is my ultimate tool for analysis and for backtesting, right? So you need your TradingView either in your Android or in your desktop, but the desktop will always be the best. So TradingView, you need TradingView, right? So either the free version or the pro version, to access some kind of tools, but the free version is also okay for you to start with. And as well, you need a Google Docs backtesting journal, right? So you need this, very important. So while you are backtesting is to journal your data. You're not just backtesting because you want to backtest, but you are backtesting because you want to gather information, relevant informations, right, that you can use to evaluate that your particular trade strategy. So you need what? You need a Google Docs backtesting journal, or you just need a Microsoft Word document, or you need a WPS, or you just need a pen and paper, a book, hard hard copy pen and paper, right? Yes, you just need that to record your data being backtested, right? Very important. So after this, access to clean historical chart data. So you want to access clean historical chart data. Don't worry, we'll go into the practical session soon, but let's just finish this. So we'll use our trading view, and then we'll use the bar replay tool, and then we'll go to past price data. Yeah, so next, what you need to do before you go over to backtesting, so first of all, you have already defined your edge. You have already learned a particular strategy. Please take note, you don't just go and start backtesting, no. But then you have learned a particular trading concept. Maybe it's the ICT concept, maybe it's the price action, the support and resistance, maybe it's whatever strategy. So whichever way, you have learned a strategy, then you have the strategy criteria, the setup confirmation, that is the rules, the entry condition, the SL, you have all of this in place. So first of all, you have defined your what? You have defined your trading strategy, that is, you have defined your strategy rules. So for the purpose of this session, we will use the Gaussian FS breakout plus supply and demand strategy. If you want to know about this strategy, you can check in the comment section. Okay, you can just comment in the comment section that I want to know more about this strategy. Then I'll get the reply there. Yeah. So strategical rules. So in this strategy, we have setup confirmation. We have first identify key supply or demand zones on the higher time frame. Example 1 hour or 4 hour. So a technical analyst will know about this now. Technical traders that are trading. But just in case you have not, yeah, you don't know about this demand and supply zone, don't worry. You can check my videos. You see a video on supply and demand and do well to watch it and to do justice on that. So now, after identifying the zone, this is part of the strategy, this setup confirmation. You will wait for price to break out of a range, that is to break out from a structure. It can be a high or a low structure. Yes, so after the breakout from the structure, so what do we wait for again? We wait for confirm breakout with momentum up. Yeah, so this breakout, we are not just rushing, not just a kind of market tap. No, we want to see a good momentum breakout, that is with body break, not with weak, not with that kind of rejection, but we want to just get a good body break. That is the first setup confirmation. So after that now, so you can see no weak violation, just with good body momentum. You can call this marabuzu. Yeah. So the next one is what? Entry condition, because first this is the setup confirmation. So after the setup confirmation, these are the confluences we want to see first. Then now we now check for these conditions, for the entry conditions to be met, and then we pull in the trigger, right? Yeah. So now we wait for pullback into the zone. So now we're waiting for pullback into which of the zone? Into the zone that was broken. When a resistance is broken, it tends to be a support. That is just a general view. And then when a resistance is broken, there is a short, there's a supply, there's either an order block from that zone, or yes, there's either an order block, either a supply zone or a demand zone, and then you can use that as a zone for retest, right? And the breakout zone again, you can use that as a zone for retest. And after the retest, what are we waiting for? We want to see a change of direction. So maybe it was a bearish breakout, a sell momentum breakout. So what are we waiting for? After that sell momentum breakout, we want to see a retest to that zone, to any of those other block. If it's bullish, a bullish order blocks. If it's bearish, a bearish order block. In our case, a supply or demand zone. And then after a retest to that zone, we want to see a candles, like we want to see some kind of rejection at that area, and then the ultimate, we want to get a good order confirmation candle, like the engulfing. Very important. So maybe we can get a pin bar, can get an inside bar, but then we need to get this engulfing. You need to engulf those, engulfing. So maybe when we're in the chat, in the practical section, you come to see about this, you come to know about the strategy. So but the purpose of this is to backtest, it's not about the strategy. So now execute trade on M15 or M5. So this is one. Now this is a day's trading. This is a day's trading strategy. It's not a swing trade. So you can see, because the time frame for execution is 15 minutes and 5 minutes. So it helps you get a good risk to reward. Yeah. So now SL and TP setup. So you put your SL above the supply or the demand zone, and then the TP you target 1:2. So this is for day trading, right? It's for day trading. There are so many trading approach, but take this as day trading. So TP is 1:3, risk to reward minimum. So if that trade is not rewarding me, maybe 1:3, then maybe I might ignore it. But then I might consider a good probability setup of 1:2.5. But then why I stick to 1:3? To enable me, to enable me have good good accumulative returns, that is to be profitable in the long run, right? Yeah, because if I should risk 1% to make 3%, you know, if I should just get three winning trades, I'll be on profit. And then maybe if I should get in a 10 trade evaluation, if I should get five winning trades, I'll be on 15. Okay, I'll be on 3 5 times 3, that is 15 arrow profit, right? And then maybe five of those trades are losing trade. 15 minus 5, that is 10. So I'll be on 10 arrow profit. So that is why I stick to this 1:3 risk to reward. All right, so this one now is in the trading plan. So maximum trade per week, 3 trade. So stick to the strategy, no guessing. So this is the strategy, this is a whole lot. So now in our back testing, we go to our trading view, and then what are we doing? We use the replay button, and then we go back to past data. We can choose a particular date to start with, and then first we identify good key levels, supply and demand zone, and then we wait for a breakout from a range. After this breakout, we mark out the zone that was broken, and then we wait for a retest confirmation, a pullback or a retest confirmation. And then to get the ultimate confirmation, we wait for a rejection of that zone, that is with a pin bar or inside bar, and then an engulfing, and then we take the trade using the 15 minutes or 5 minutes time frame. So this is the strategy. So this is the working system. You can see this is system already. So what do? You can decide to test this now in Euro USD. You can decide to test this in USD JPY. You can decide to test this in USD CHF, on gold, on as the case may be. So first, we worked on our strategy using these tools and these platforms. We worked on this strategy. So okay, this strategy, you might learn this one. You learn this strategy. So this is my personalized strategy. If you want to learn it, like I said, comment in the comment section, and then I'll be with you. And now we are done with this. So what is the next thing for us to do? We'll go over to journaling, right? Yes, we'll go over to journaling. And why are we journaling? We are journaling because this is a kind of research. We are carrying out a test, carrying out a research test. So all the outcome will be inputting it, and then we'll have an evaluation for them. So first, now you can use this backtest journal format. So for each backtest trade, record the result here. So maybe for the first trade, you record the date. Maybe it was January 2024. So this was last year. I just did this as an example. So Euro USD. So you can add the screenshot, very important. You add the entry price, you add the SL of that particular trade, and the take profit, and then the risk to reward 1:3. Most times you can get 1:4, 1:5, 1:4.5, 1:3.5, or as the case may be, but 1:3 is the minimum, right? Yeah. So you record, was the trade successful or not. If it was win, you write win. If it was lose, you write lose. And then this note, I guess this column is small, but then at least you can see it. So now we have, okay, you just, this is simply your observation. So now you can see the comment I gave here. I say clean supply and demand bounce. So now what this is telling us is that after the breakout, the market bounce up from the supply and the demand zone exactly, and then which was a good confirmation for me to venture into the trade. So you do this for the first trade, you do this for the second trade, you do this for the third trade, right? Yes, you want to do this for as many trade as possible. And then okay, you have to choose a pair. So you can, like I was saying, you can use Euro USD, GBP USD, Nasdaq, gold, USD, anyone at all. So you can choose any of them. So after you choose this, pick a historical data range, start replaying the trade. All right, so we'll do this in the practical section, and then lock every valid setup and result. So this is what we mean by the lock. You feel it, feeling it there. All right, so once we are done with about 20 trade is just small, but depending on the kind of trader you are. If you are a swing trader, then 20 trade is a whole lot. Then what are we calculating from all of these things now? What are we calculating? So this is our interest, because this is what defines our strategy. First, the win rate of that strategy. So maybe if we take 20 trade and maybe 15 of them are wonderful. So we can now calculate the win rate. What is the formula for calculating win rate? The win rate is the successful trade all over the total amount of trade times 100. That is for your win rate. So let me just use a random number or a round number. So let's say if we took this 20 trade and then 10 was successful and 10 wasn't successful. What do we get? We get a 50% win rate, because 10 is 50% of 20, right? So 10 is 50% of 20. 10 of the trade were successful and 10 weren't successful, so we have 50% win rate. So first we have figured out the win rate. So number one, we have figured out the win rate. So what is the next one again? Is the average risk to reward. So like I said, the minimum is 1:3. So that is just for me. So imagine in that your trade setup, you see consistent 1:2.5, or maybe 1:4. Let me just not use 3. So you're like, okay, this on Euro USD, it is more consistent with 1:2.5 instead of 3. Maybe 1:3 will always come back and hit break even, but 1:2.5 will always go successful. So you can observe that, right? You can observe that. So these are our observation now. So first, the win rate. Second, the average risk to reward. And then what? Your edge consistency. How consistent is this strategy? So this is it. We can test it on Euro USD and find out that okay, Euro USD will be having a kind of 80% win rate, and then on GBP USD we'll be having like maybe 75% win rate, and maybe on Nasdaq we're having like 50% win rate, and then maybe on gold 60% win rate, and then USD JPY maybe 70% win rate. So now you see that this strategy works in different in different in different it works in different, how will I put it now? Okay, you can see that this strategy has different results for each of these pairs, and it will be like that. So when you are learning a particular strategy on a particular pair, maybe the person that is teaching you is using it on Euro USD, and maybe you intend to use the strategy on gold. For you to know the effectiveness of that strategy, you need to back test. So when you back test, you have a different win rate for this, have a different win rate, and a whole lot of stuff. So what you just need to know is that you are in this game to make money. You don't need to bore yourself with a whole lot of stuff that is not giving you the edge you want. So you need to go for the one that will give you good win rate, the one that will give you good high risk to reward, because that's the essence of backtesting. You're not just backtesting to show that you know how to use your strategy, but then you are backtesting to have to refine your strategy in such a way that it is an edge for you. It's an advantage that can apply to the market, and then you are profitable. All right, so this is the so finally finally, so this is the final summary now. Backtesting is an invaluable tool for traders aiming to develop and refine their strategy, right? It's an invaluable tool for traders aiming to develop and refine their strategy by providing insights into a strategy's historical performance. It allows traders to make informed decisions, manage risks effectively, and approach the market with greater confidence. However, it's essential to conduct backtesting thoughtfully. Please take note, thoughtfully, being mindful of its limitations and ensuring that strategies are robust enough to adapt to changing market conditions. So once again, let me just recap the most important parts again. So first, we say backtesting is we are applying our age on historical data to see how it works, to see the effectiveness of the strategy. And number one, backtesting helps us in validating our strategy effectiveness. Number two, it helps us in it enhances our confidence in the particular system, that is the strategy. Number three, it helps us identify weakness and strength in the particular strategy. Number four, it helps us improve risk management. Very important. Number five, it helps us, it supports data-driven decision. Support data-driven decision, not emotion or assumption-driven decision. Right here. So now the pitfall to avoid is overfitting. You don't want to overfit the strategy. You don't want to ignore the market changes. You don't want to neglect transaction cost. You want to put all of this in perspective. And again, you want to go into backtesting. First, you need to identify your strategy. You need to learn a particular strategy. Whatever you have learned, you just need to learn a particular strategy. So if you don't have a particular strategy, comment in the comment section that I don't have a particular strategy, or then you can watch my videos to learn or to model a particular strategy. Right. All right. So first, after getting the strategy, you set up, from a trading view, your Google Docs or your journal, your notebook and your pen, and then access to clean historical chart data. So this is why this clean is of emphasis. There are some brokers that the data are not that clean, right? So if you have been doing analysis, you know that there are some brokers that don't offer clean data. So you want to use a clean data, a clean historical data for your analysis. Yeah. So this is the edge, and now you apply the system, and as you're applying it, you journal your trade. You can take, and first you choose your pair, which pair you want to trade. You choose a date, a historical date range, and then you start applying your system. You journal, apply your system, journal, and when you are done, you now evaluate it. You evaluate the win rate of that particular strategy on a particular asset, and the average risk to reward on that particular asset, and then the consistency of that strategy, right? And then boom, you are good to go. I tell you the truth, if you can get this done, this, in most times, this is what makes traders feel that they are god in the market. They'll come and say, I have this secret in technical analysis. 1 p.m. 1 p.m. New York session. All of this thing is just as a result of backtesting. So if you can put in the effort and backtest, you too, you also be a god. But then remember that the market is always king and the market is always right. So in all you do, prioritize risk management. All right, so thank you very much. I hope you found value from this video. So just stay tuned as or check the video somewhere around on the practical deployment of our backtesting. So thank you very much. Do well to destroy the subscribe button, you scatter the like button, and then you give a reaction of this video in the comment section. Thank you very much.